everyone. Thanks for coming along this evening, and thanks to everyone who is watching online. My name is Mehreen. I'm Director of UK in a Changing Europe. For those who don't know, UK in a Changing Europe exists to try and spread the word about the findings of research. Given that, we're very keen to debate those findings and to have discussions about what the research says. And it's with a view to doing that that we're here tonight. I think it is fair to say that the majority of professional economists take one view on the impact of Brexit. However, as we are all aware, there is a debate about this, and we thought it was long past time to sit down and have that debate in person, so that's what we're here to do tonight. We're going to have a couple of presentations to kick us off, then we're going to have a debate within the panel. Please submit your questions using Slido if you can, because it helps keep things moving. The aim is to have as good a debate as possible, to get through as many of the issues as possible, and to do it efficiently and politely. Throughout the course of the evening. Politely is quite important as well for those who want to stick their hands up and ask questions. But without further ado, I'll kick us off by handing over to Mehreen, who's economics editor at The Times and who has very, very kindly agreed to chair tonight's event. Mehreen.
Thank you, Anand. Thanks everyone for joining us and for everyone who's online. My name is Mehreen. I'm the economics editor at The Times, a job that I've been doing for almost a year. And during that time, economics coverage in the UK has been dominated by stories around inflation, now financial stability, and also Liz Truss. So I'm quite glad that we have an opportunity to actually refocus a little bit on Brexit, which I think amid the sort of maelstrom of sort of mini crises and shocks the UK economy has been having, is perhaps got a little bit less attention in the last year or so, as policymakers are, battling different types of demons. As Anand mentioned, there is a consensus. You will find it in most mainstream newspapers, including my own. So I'm very excited that we'll be able to represent, I think, a view initially. So the first part of this debate is going to be a few presentations. We're going to be hearing from two of our panelists. Then John will come up and do a little bit, and we will then go onto the table and have a discussion. I'm very keen to involve everyone's thoughts. So if you are burning to ask a question, if you put it into Slido, I will see it, and hopefully we can incorporate people's thoughts as we go along. I imagine that this is going to be quite a dense or numbers dense initial half of the debate. I don't want anyone to get sort of lost in the models or the figures. So hopefully we can keep this very accessible. I'm looking at everyone here. We can keep it very accessible and open for people to feel like this is a safe area for them to ask any questions. My job as a journalist is usually, hopefully, to ask the dumbest question in the room, so I'll be very happy to do that too. I'm going to introduce everyone in the order they're going to come up to speak, and then first of all tell you who our five great panellists are. We're going to start with Gudgin, who's from the Centre of Business Research based at the University of Cambridge. Graham is going to kick us off with his, I don't want to use the word contrarian because I don't like that word, but his thoughts on what Brexit has done to the UK economy so far, and probably breaking with a little bit of the consensus. And then he would be followed up by Julian. I think that both of their presentations are going to build upon one another. Then we have John Springford, who is from the Centre for European Reform, Deputy Director of the Centre for European Reform, which celebrates its 25th anniversary this year, I was reminded, who's going to come up and initially, I think, address some of the points that the first two speakers are going to make about some of John's work, which is sort of creating a sort of counterfactual doppelganger model about what the UK would have looked like if we were still in the European Union. Then we'll sit over onto the table, and we have two initial respondents, Sophie Hale, principal economist at the Resolution Foundation, who works on Brexit issues and trade issues, is going to give her thoughts. And then finally, we have Jonathan Portes, who is a fellow at UK Changing in Europe and also does economics and public policy at King's College, will give his initial thoughts, and then we will get into it. We have 1 hour and 45 minutes. Sometimes as a moderator, I'm in a bit of trepidation when we have so much time, but I think on this occasion we're going to have more than enough to get our teeth into. And to kick us off, I will hand over to Graham to give us his presentation. Thank you, Graham.
Thank you very much, Mehreen, and thank you very much for the invitation to talk. I'm most grateful to Anand and his colleagues for this opportunity to examine the economic impact of Brexit. I think both Julian and I both recognise that there is a near consensus at least among what used to be called the chattering classes, that the impact of Brexit has been both negative and substantial. But our contention is pretty well the opposite of that. And it is that this consensus is not based on any very sound evidence and is magnified by an unbalanced coverage in important parts of the media, some of which Mehreen used to work in, so I won't name names. But in this presentation, we just want to focus on the facts of the matter. Our full evidence is presented on a long report on the Briefings for Britain website, and in this report, and we've got a few copies here if anyone wants to take one away. So, let's start with GDP. What's actually happened to GDP since the referendum and since we joined the single market in beginning of 2021? We can see there that over the longer term, the UK has followed the G7 reasonably closely, but coming out of the recession around COVID, the UK recovery has been a bit slower than the UK than the G7 average by a couple of percent. But if we take the US out of the G7, then the UK is actually better. So it looks like the UK is pretty important in this. And the reason why the US plays a big role is because there's been a really quite strong fiscal expansion in the US under both Trump and recently under Biden. There's the evidence for it. I won't dwell on that, but we can come back to it in questions if anybody wants to talk about it. Here's the individual members of the G7 looking at growth in GDP since 2015, just before the referendum. The UK is the solid red line, and you can see it's pretty much in the middle there. It's better than most, well, similar or better than most European members of the G7 and Japan, but it's been slower than the US, which is the purple line at the top, and Canada, the one underneath. Now, there's two things to say about this slide. One is, if you get your magnifying glasses out and look very carefully, you can pick a period at the end of 2019, just to the left of the first vertical line. Pick out a period there when the growth between then and the latest figures at the end of 2022 are just slightly negative for the UK. And the UK over that particular period was the slowest growing of each of those countries. But look, it's very slight. It really doesn't mean very much in my view. And we'll have to see what happens from here on in. And one of the things about Brexit is I think it will take a while for us to really know whether the impact has been negative or positive. My own personal view, and I did quite a bit of modelling on this in the days when the Treasury was was allowed to put out reports. And my view always was that it would make very little difference either way. And that seems to be happening, but we'll have to see. Sorry, just one other thing to say about this is there's a measurement problem here. The way the ONS measures output in the public sector in the UK is different from nearly all the other countries, and it exaggerates the downturn. For instance, on their measure, there was something like a 20% fall in the output of the NHS during the pandemic. Now, my daughter and son-in-law both work in the NHS, and it was news to them that there was any fall in output since they were working their socks off. Other countries do it a different way. And it's probably the case that the UK's fall in GDP in the middle of the pandemic was probably about half of what's normally shown in the figures. And that affects the recovery as well. So we can look at something like manufacturing output, which isn't affected by measurement of public sector output. You can see that, sorry, in this case, the UK is the blue line. We can see the UK has done better than France, Germany, Italy over the whole period. If you take the later latest period since we joined the single market, beginning of 21, then there's some convergence back. But whether that's of any significance or due to Brexit, we'll have to wait and see. But overall, if we take the whole period from the referendum right the way through, manufacturing output in the UK has outperformed the other countries. Now, it seems to me that having seen this evidence, that ought to be enough, really. The UK is clearly doing okay. We'd say that not much evidence that Brexit has helped the UK, but very little evidence that it's hindered it either. But quite a few commentators are not willing to let it go at that. So it's been quite common and well publicised to have counterfactuals instead, arguments that the UK, which usually produce the conclusion that the UK was doing better before Brexit than most other countries and would have continued to do so. And the fact that it hasn't, therefore, suggests that even though the UK is doing okay, it could have done better, and the effect of Brexit is therefore negative. The most widely publicised of these, I think, is the counterfactual exercise undertaken by the Centre for European Reform, CER, in what's usually called their doppelganger analysis. And what they did for GDP was to have an index which was a weighted average of 22 other countries. It's the dotted line here. So it's quite similar to the UK before the referendum, which is marked by the vertical line there. But afterwards, the UK falls below it. And the conclusion, I think, of CER, John will tell us, is that the UK has underperformed by about 5.5%, and that's the loss due to Brexit. There are the weights for the 22 countries. So US at the top, about 30% weight, Australia, New Zealand, and so on. Greece is in there, Iceland, Ireland. But one of the first things, well, two things to say here. First is it's tuned up to 2016 on a period of recovery in the UK from the recession connected with the banking crisis. But the more important thing to say, I think, is that there isn't much correlation between individual members of this index and the UK. So the UK is blue here, and the other two are Australia and New Zealand. So they're clearly growing faster than the UK. They grew faster before the referendum, and they've continued to grow faster. So not terribly obvious why you would want to have them in an index. Even worse is somewhere like Greece. So you can see Greece was in a real mess up until just before 2016. The UK was growing, but the Greek economy declined by about 25%. But the decline did stop. At least there was very little growth after 2016, but at least it wasn't declining. But that change from decline to growth helps to bump up the doppelganger index. But here's the key thing. The doppelganger index is almost the same as the US. So you could just say, let's compare with the USA rather than all these 22 countries. What are the other 21 countries doing? Well, they're just, some of them are faster, some of them are slower. They're offsetting each other, perhaps just filling in little gaps here, but contributing very little in aggregate. And when I look at this, by the way, and do a regression, no country other than the US is statistically significant as a long-term influence. So these other countries in this index are also not statistically significant. So what happens if we compare, let's say, Germany with the US? You get something which looks even worse than the UK. UK was a 5% gap by the end of the period. Germany is about 10%. So Germany seems to have done worse. So if you follow the CER's logic, I think you ought to say that Germany was suffering from a really bad effect of Brexit. And what about Japan? There we got about 20% fall. Even though it's a long way away, Brexit has a long reach, and and so on. So look, our conclusion is that this is really a statistical artifact. The index includes places like Iceland, which only got two exports to talk about, hardly a comparator for the UK. Also includes Ireland, where the GDP figures are close to meaningless because of its tax haven status. What Paul Krugman, the Nobel Prize winner, calls leprechaun economics. Could I just get a drink of water there? So we view this as a statistical artifact, and other than the US, it hasn't got much meaning. And it's fairly obvious why the UK, Germany, Japan, and other countries fell behind the US after 2016, essentially after Trump became president. So let's move on quickly now from GDP to investment. And perhaps the most common, and we would claim misleading claim, is that Brexit has reduced business investment, thereby reducing growth. And in the calculations of Jonathan Haskell of the Bank of England, cost each family in the UK £1,000. This is achieved by putting a trend through a cyclical upturn. Again, the post-banking collapse cyclical upturn in business investment. This graph, by the way, is one of the most common you'll see anywhere. It's appeared several times in the Financial Times. It's appeared twice on a Newsnight programme 2 weeks ago. Just in case you didn't get the point first time, they thought they'd show it again. So the idea is you have a trend here. You assume this trend goes on essentially forever, and the UK has underperformed.
Just as a point of order, Graham, I mean, Jonathan's not here to defend himself. I mean, I've got his paper here, and his trend line starts in 1998. He doesn't do it in 2006. So,
Okay.
I'm just making a point of order here, but that's not what Jonathan did. I just think it's fair on him to.
And on this issued fatwas about not going over time, so I hope that could be added onto my time. But but please do make points like that. Fair enough. If you fit a longer-term trend from 1997 through to 2016, it's that. And the importance of this is that by 2016, by the time of the referendum, then business investment would have been well above trend, and you can reasonably argue that it was then due for a cyclical downturn. Indeed, when I fit equations to this, it does predict a downturn after 2016. UK in blue there, Germany in brown. You can see from 1997, right the way through, business investment, not that different from Germany. And the UK finishes up a little bit above Germany. It's below France. France was faster growing business investment before the referendum and continued to be faster afterwards. Now here's Jonathan Haskell's chart. Seems to me it's fair enough to show it whether he's here or not. And what Jonathan did was to fit a trend between 2 points, one in 1997 and the other one second quarter of 2016. And the importance of that is that if you fit that trend, then 2016 has to be on the trend, because that's how you fitted it. And therefore you can't argue, or you don't know whether that point is above or beyond trend and what was likely to happen. Jonathan then just increases it 2%. He then allows for the pandemic, but he adds on 2% per annum all the time. One other point to notice here is he was using out-of-date data, and the revised data from ONS is about 10% higher at the end than his data. And finally, on investment, let's look at foreign direct investment into the UK. This is in millions of dollars, UN data. And UK is the top line in blue. Very little sign there that Brexit has affected anything very much. And if foreign investors aren't too concerned about Brexit, I mean, they're the people this is where I might expect it to show up, where, excuse me, where if investors were worried about Brexit, we'd perhaps expect that line to come down. Some people have pointed out that the gap with Germany has narrowed, but the gap between France and Italy and the UK hasn't narrowed. Seems to me, again, UK doing okay. Then finally, in my section, let's come on to trade. This is UK export volumes, excluding oil and erratics. And here we see the blue line is UK exports of goods to the EU, and it's recovered the previous level. But actually, I think this is quite significant. It's done better than UK exports to non-EU countries. There have been all sorts of things going on here. There have been supply shortages of chips, for instance, from the Far East, which have affected car exports to both Europe and elsewhere. But if UK exports have been doing better to the EU than to other countries, again, it doesn't really suggest that Brexit has had a big effect. Some people have tried to say, well, difficulty of getting imports from Europe has affected exports to anywhere else, but really I don't think that. Doesn't seem to be much evidence for that, and it doesn't seem a very logical argument. This was just to show the turbulence around 2021. There was some stock building just before we left the single market, and then a big downturn, particularly in January. And it's taken a while, taken something like 18 months to recover, but it does look as if we've recovered. There is evidence, I think, that small companies have found the additional paperwork onerous and stopped exporting to Europe. But that effect doesn't seem to be large enough to really affect the total or the aggregate. What should we have expected? UK goods exports to the EU tend to follow manufacturing output in the Eurozone, which is the blue line. And certainly since we left the single market, quite a bit of turbulence there. But by the end, we seem to have got back to that long-term trend. So again, I think no great impact there, and pretty well ditto for service exports. So, conclusions. 3 conclusions here. Firstly, no real evidence of substantial negative impacts on the UK economy due to Brexit, despite what you might read in the paper or hear on the BBC almost any day of the week. Attempts to use counterfactuals, in our view, are just grossly misleading. And I think we really would argue that people should stop doing that sort of work. It's leading to a wrong conclusion. And finally, I think the continued focus on Brexit and mention of Brexit as a negative impact, we feel is undermining true understanding of the UK's economic difficulties. UK has real economic difficulties, and these really started at the banking crisis. The lack of growth in productivity, or the lack of sign of any pickup in productivity since, is a real problem. It affects public expenditure, affects everything, like all the holes in the road. I don't know what it's like in London. In Cambridge, you take your life in your hands driving anywhere. So the slow growth of the UK economy is a real problem. But in our view, it's not due to Brexit. And if people would stop saying so, then we could start to concentrate, I think, on what the real factors are. With that, I'll finish. Thank you.
Thank you. Do I actually need the hand mic, or is the... No, I didn't think so. Great, good. Okay. What's that? Right, some bonus charts that I'm going to ignore. Right, okay. Well, Graham's talked primarily about the impact on GDP, investment and trade. I'm going to focus on the impact of Brexit on sterling and on inflation, and then wrap up with a few general remarks about what we think the overall impact may have been. I thought actually, funny if I would start with a counterfactual, just to show that they have value in both sides of the debate. You will often have heard it said that Brexit led to a collapse in the value of the pound in 2016 in the wake of the referendum vote. So what this chart does is it shows an index for the value of sterling against a basket of other major currencies, weighted according to their importance in UK trade. And you see I've marked the period in the years before and the years after the vote to leave the EU. Now, I hope you can sort of get two takeaways from this straight away. One is that the fall in 2016, which actually, by the way, began in 2015, actually did little more than reverse the increase in the value of sterling between 2013 and about 2015. And also in the bigger scheme of things, it's nothing remarkable. If you look at this chart too, it's not as if sterling had been a sort of a safe haven currency, rock solid for decades. In fact, it had been in long-term decline for about 50 years. If I move on to a possible alternative explanation for why sterling fell, I'm not, of course, saying that the result of the referendum didn't have any impact on the timing or the extent of the fall in 2016. I mean, clearly, sterling tanked the day after the vote came through. Instead, my counterfactual is that it probably would have fallen anyway, to some degree, perhaps over a longer time horizon. And to illustrate that, this chart shows what's happened to the UK's current account balance over this period. And that basically is the sum of trade in goods and services and various investment flows, like the money that we're earning on income, on interest, or paying in interest and dividends and so on. And you can see, again, I think two key points on this. One is that there had been a very large deficit accumulating ahead of about 2015. So before the referendum, the UK's current account deficit hit about 7% of GDP on national income. That's a really big number. And it would suggest that sterling at that point was significantly overvalued and due for a fall. And the second point, indeed, lots of people were saying that at the time, including people like the IMF, arguing that sterling was probably one of the most overvalued of the major currencies. So if it hadn't been Brexit that triggered the fall, it may well have been something else. The next chart is inflation, specifically food prices. Now, what I've done here, I've shown the level of food prices because I sometimes think it's easier to see what's going on over a long period rather than looking at the annual inflation rates. But the story is pretty similar. As it happens, this chart doesn't include the numbers that came out earlier today. I did waste about 4 hours of my life going through those numbers. And if you want to go on my Twitter feed, there's a detailed explanation of the breakdown of what caused the jump in inflation. The key point, though, is they don't actually change the big picture. Interestingly, food prices rose more in the European Union in February than they did in the UK, despite the shortages of tomatoes and strawberries and so on and so on. So my main takeaway instead from this chart is basically the food prices have risen over the last few years by actually slightly less than in the European Union, but it's not significantly different. Now, you may well be aware of some academic work suggesting that Brexit might have added 6%, for example, to food prices between 2020 and 2022. My issue with that is that how do you square that with this data suggesting that food price inflation has actually been lower? I think you need to look for maybe alternative explanations for why food price inflation would be lower, or, in my view, suggest that your model actually isn't very good. Turning to core inflation, so this is a measure of inflation excluding food and energy. Adam Posen, in particular, has been keen to draw attention to charts like this that do seem to suggest that UK core inflation has picked up further than in the European Union since the vote to leave the EU. And the logic of doing that is to say that, well, food and energy price shocks were common, but what's happening to core inflation is more of a specific UK problem. Now, to be fair to Adam, he was, I'm afraid, widely misquoted. He was quoted by at least one newswire as saying that 80% of the UK's inflation problem was due to Brexit. That wasn't quite what he was saying. What he was saying is 80% of the UK's problem in the sense of why our inflation is higher than other countries. So the difference between the two is due to inflation. However, his version of this chart only actually started, if I remember right, in 2016, so only showed the period since the referendum. I would draw attention to the fact that UK core inflation has almost always been higher than Eurozone core inflation, and typically tends to follow that in the US for whatever reason. Adam Posen also suggested that if it's not Brexit, what else? I can think actually of two reasons. One is energy prices. Now, I know energy prices are excluded from the excluding food and energy measure of inflation, but that only strips out the direct effect. It doesn't strip out the indirect effect of higher energy prices on the cost of doing anything else in the country, including running a restaurant or a shop and so on, all of which are in core inflation. And the second point is the policy responses. I mean, particularly during the COVID pandemic and even more so in the energy crisis. Governments in Europe tended to focus on things that reduced measured prices, so for example, cutting VAT. Whereas in the UK, we focused on subsidising incomes, which supported real incomes but didn't affect measured inflation in the same way. Next slide is a general slide about, in this case, comparing the UK and Germany. Adam Posen at least got the data right. I'm going to have a very quick go here at Mark Carney, who produced a very bizarre claim that the UK had shrunk from more than 90% of the size of Germany's economy to 70%. That was what we economists call a bit naughty, because he was essentially using market exchange rates rather than purchasing power exchange rates. And I'm pleased that one of the other panel members today, Jonathan Portes, also debunked that claim. If instead you simply look at what's happened to the level of real GDP in the two countries over the last decade or so, again, it's pretty similar. Our growth, in particular since 2016, has been actually marginally better than Germany's, but again, not significantly different. The UK did underperform during the pandemic. I suspect partly explained by the better measurement of our GDP, as Graham mentioned. I think, by the way, that factor is still dragging on the official measure of GDP. It's quite striking how the latest monthly GDP numbers, the ONS statisticians have gone out of their way to measure how many people were actually going to school, how many children were being educated. So actually looking at measuring the output of public services rather than simply looking at whether or not teachers are being paid and then concluding that output hasn't changed. So I think there's a continued measurement problem in there. A few other quick German lessons. I need to update this first point because food price inflation in Germany is now something like 21-22%. We found out this morning that it leapt to 18% in the UK. But the key point is food price inflation is higher in Germany than it is in the UK. Real wages, also really interesting. They've fallen by more in Germany over the last 3 years than they have in the UK. If I was going to push my luck, and in particular if Jonathan Portes weren't standing in front of me, I would claim this as a Brexit benefit, because it would suggest that labour shortages are actually boosting the wages of British workers in sectors like road transport and health and social care. But that leads me to my third point, is the extent to which Brexit has caused a sustained loss of EU workers. And it's clearly true that a lot of EU workers have left, or not as many have come here since the referendum, and particularly post the pandemic. But if you look at other countries, they have suffered something similar, not necessarily to the same degree, but Germany also saw a big exodus of EU workers during the pandemic, and many of them have not come back. So I think it's important to compare what's happened in the UK, not just to its own history, but also to what's been happening in other countries. So finally, just briefly, some conclusions from all of this. I think there is a lot of value in counterfactuals, and I could actually, if you like, criticise my own side for not using them more often. So, for example, I often see Brexiteers saying, look, UK unemployment is a lot lower than unemployment in the EU, that's clearly a success of Brexit, whereas, of course, in practice, UK unemployment has always been lower than that in the UK. But I'm still not a fan of doppelgangers. I appreciate what John and others are trying to do, but I'm just sceptical of the idea that you could take a group of countries that have performed similarly to the UK over a previous period under one set of circumstances and use that as a reliable benchmark for a different period in a very different set of circumstances. I think sometimes John tends to assume away the impact of COVID and the energy crisis. I think there are good reasons why COVID and the energy crisis might have hit countries in the doppelganger group very differently from those in the UK, including particularly countries like Australia and Canada that are major commodity producers. So, of course, they weren't hit as hard by an energy crisis as the UK was. I'm also aware of what I call here the sins of aggregation. A particular hobby horse of mine is when people compare GDP in, say, the European Union with that in the UK, not taking account of the fact the European Union, of course, includes a lot of poorer countries that you might expect to be growing relatively quickly. And even the euro area includes Ireland, where the numbers, of course, are crap. So I think it makes sense to compare the UK with individual countries, which is what we tend to do, rather than the aggregate. Naive extrapolation of short-term trends, I think that's a criticism, particularly of some of the work that people have done on looking at what's happening to business investment. And then my sort of two general concerns, and again, I think it'd be fair to criticise both sides of the debate for this from time to time. One is sort of too much tunnel vision or confirmation bias. So you have a theory that that Brexit has crashed UK trade. So you look at the data and look for evidence that trade has fallen, and then you attribute that to Brexit, without necessarily thinking of alternative explanations or looking at other countries and seeing if something similar has happened there. And then finally, what I call failing a basic smell test. How plausible do you think your numbers are? I think if the doppelganger model had suggested that GDP is, say, 1 or 2% lower than otherwise, I would have thought, yeah, plausible. Yeah, I could run with that. But when it says 5.5%, then I think that just doesn't smell right, and I'd want to look deeper into what the analysis behind that is. But that's more than enough for me. Shall I move on?
Okay, well, thanks very much for having me. Anand and Mehreen very kindly said that I can have just 5 minutes to respond to some of the criticism of my work, which is good to them. So, first thing is, counterfactuals obviously can't possibly be perfectly correct. We can't go and visit the universe in which we remained in the European Union, measure the GDP of the UK, and then come back and tell everybody what happened. But there are better and worse counterfactuals, right? The first point to make is that individual countries, which Julian says we should look at, can't possibly be good counterfactuals. They have different economies, they have different policies, and Julian pointed out that Greece had a massive depression. That's absolutely right, but that's why it only makes up a very tiny proportion of the doppelganger that I put together. They're also right that the US is a bad comparator because of the fiscal expansion that went on. Completely agree. And in their paper, which Julian and Graham put together for Briefings for Britain, which I think some of you may have had, they say, right, well, what we should do is just compare to France and Germany as individual countries, because they're in Europe and they're kind of medium-sized economies in a global context. And hey presto, if you compare to France and Germany, you don't see much of an effect. But if we look at France and Germany over the long run, we can see that this is a real problem. They're not very good comparators. So this is faster growth. This is basically GDP indexed to the second quarter of 2016. Here, the referendum. The more diagonal the lines are, the faster the growth is, and the flatter, the less faster growth is. You can see the UK here, which is the black line, goes along like this. France and Germany, France is the blue one, flatter, Germany also flatter. So there are some structural growth rate differences here which make France and Germany a bad comparator. They're right about the US, right? So if we look at not necessarily the exactly what happens, but we see that in this growth phase, the gap between the UK and the US is similar. The lines are fairly parallel. And in this phase, they are too. But, as they say quite rightly, when Trump gets in, he cuts taxes, and then we have a big COVID fiscal stimulus, much bigger than our own, and so their growth is better. So I'm like, let's just not use individual countries because they can't possibly offer us a very good counterfactual. What's the next best thing you could do? Well, you can look at the UK within a range of advanced economies. And this is what we do here. So if we take the 22 most advanced economies, and Julian, it wasn't that I've included loads of poor countries here. These are the 22 most advanced economies that the IMF designated as advanced in 1995. So it doesn't include places like Korea or places like that, right? And the reason for that is because they grow pretty quickly. Emerging and middle-income economies have tended to grow more quickly than the UK has. So we've got a massive range. It looks pretty crazy. This is Greece. Julian's quite right that you see a massive amount of growth between 1999 and the crash, and then it stagnates. This is the US and Australia, Canada, Luxembourg. They tend to have a faster growth rate than us. But if we look at the UK, then we can see we're sort of on the bottom half of the pack. And bottom half of the pack here means faster growing. And that's true all the way up to the referendum. And then we start to become a bit middle of the pack. And then our growth starts to slow. And then by the end, we're doing much worse than, or doing in the bottom half in terms of growth performance after COVID. So this tells us, okay, we've got some evidence here that within the range of 22 advanced economies, the UK was pretty good. We get to the referendum, it gets worse, and then it gets worse still. In terms of what the doppelganger actually does, it tries to take this logic further, right? So the idea is, let's look at this growth phase here between the recession, the end of the recession in 2009 and the referendum. Let's try and find from these 22 most advanced economies, the combination of those economies whose performance is most similar to that of the UK. And that's not just on growth, that's on all sorts of other variables like inflation, how big their trade sectors are as a proportion of GDP, whether they have really big industrial sectors, how well educated their workforce is. So we're trying to gather as much information as we possibly can from these 22 advanced economies to try and find the combination of them that most closely tracks the UK's performance and also the UK's economic structure. And this is the doppelganger line here. And we can see that it closely tracks the UK up to the point of the referendum, and then it starts to diverge, and it ends up being quite a lot higher. Final point I want to make is just in terms of doing a check on that. So if we go back to this slide very briefly, I know we're running out of time. We can see that the UK, we can measure where the UK was in this ranking, right? It's possible to measure, okay, so here, it's about the 75th percentile all the way up to 2009. It stays around that percentile in terms of growth performance. After, it drops right back, so it becomes much worse. So we can use that to measure, to do a check to see whether the doppelganger makes much sense by saying, okay, well, let's just carry on the 75th percentile and see what happens. And we can see that in this chart here. So here's the UK. That's what actually happened. Here's the doppelganger. And then this green line is the percentile UK was in up until 2016. It was about the 75th percentile. And if we just continue that 75th percentile forward, then we see that it matches the doppelganger pretty closely. So by having a check on the doppelganger using a different method, we end up with something which looks pretty similar. So that's it. That's all I wanted to say. That's my defense of my method. And let's finally get on with the discussion.
And thank you, Julian, and thank you, John. So a lot of that was about refuting, picking up sort of, some could say maybe some straw man arguments, beating them down. I also want to get to the future. A lot of this has been about, what are the counterclaims made by the existing or the economic impact we may have seen so far, how much of it hasn't happened. I think we also want to get to, well, what are the benefits, if there are any economic benefits of Brexit? Why have they not been realised? Is that a political choice? Is that due to other forms of circumstances? And also, what is the vision of the post-Brexit UK economy? What should it look like? Sophie, I'm going to throw all of that to you a little bit and maybe get you to also speak about what we've heard. I also want to mention a couple of numbers. 4% is the number that is quoted widely by the Bank of England and the Office for Budget Responsibility as to sort of hit the UK's potential growth and productivity. And, the bank said a couple of weeks ago that maybe some of that impact has happened faster than expected, but they don't think it will change in the whole. The OBR repeated that when we heard from them last week. They haven't really changed any of their analysis around the impacts of Brexit, 5 or 6 years on. Why is their estimates pretty static? And has the work you've done really, found anything different from what we can say so far?
Thanks. So quite a few questions to try and answer there. I think I'm going to try and focus most of my comments on kind of the trade impacts that we've seen. So a lot of the conversation so far has been on the overall economic impact, the impact on GDP, although we've also gone through, the impact on inflation and other measures. But basically, if you think about what Brexit is, in its most fundamental terms, it's sort of a change in the trading relationship with the EU and a change in the sort of immigration relationship that we have with the EU. And although trade may not be necessarily the impact that you'd expect to see first, so investment is, forward-looking, ultimately these kind of economic impacts that we're seeing elsewhere should be a response to, future expectations of what you're expecting to happen to trade with the EU and migration that we're not really talking about here as much. So ultimately, that's why I think it's really important that we focus on, let's see if the trade impacts are happening, then maybe you would expect to see the economic impacts happening either down the road or now at the same time. There was one really, really small point that I just wanted to bring up. A lot of the conversation was on real GDP. But it was kind of total real GDP and not GDP per capita. And I think you could have gone away from those presentations thinking that the UK economy has actually been doing really well relative to Germany in the last couple of decades. And I think you'd be quite wrong to take that away. The UK's done quite badly. And to be fair, Graham did bring that up in his conclusion that the UK's long-standing very weak performance, economic performance, is of concern, and whether you think that's because of Brexit or not, or whether you think it's because of various factors that predated Brexit and Brexit, it has had a very kind of extended period of weak productivity performance. So sorry, to go back to trade, there's two things that you would have expected to see, and these kind of get brought up most of the time. So first of all is underperformance of the UK compared to comparators, and that's what we've heard quite a lot about already. So the UK should be performing worse than the countries that look like the UK. The second thing is what got brought up when we did briefly look at trade earlier on the screen is that you would expect the UK's trading relationship with the EU to fall relative to its trading relationship with non-EU. And that's because you've introduced the barriers just on EU trade and not on non-EU trade. So when we think about, are these materialising and is the evidence there for those materialising, most people were kind of expecting to see, the consensus, was that we were expecting to see both of those impacts materialising. And so to come to your kind of question, which was, the OBR and the Bank of England are still saying that these impacts are kind of on track and that they're happening. I think what they're particularly looking at is, or what they have kind of looked at is whether there is a difference between the EU and the non-EU trade share. And what I'll talk about now is what's happening to kind of the UK's underperformance compared to kind of other countries. So the analysis that we did, that just took a bit of a stock take. We're kind of 2 years post-Brexit in terms of the amount of data that we have, or at least 2 years into the new trading arrangement, so trade with the EU under the Trade and Cooperation Agreement terms. And what we saw in 2021, so the first year, was this really big deterioration in trade openness. And, depending on the data that you look at, it looks like it's kind of improved a little bit in 2022. It's important to say a lot of that is because of these the precious metal trade, which is you should just exclude and was excluded in the charts that were shown earlier, under the kind of erratics category. And when you kind of strip that out, goods export growth does look pretty much the weakest in the G7. Imports of both goods and services also look the weakest in the G7. So these do kind of align with that the consensus expectation that the UK would be underperforming countries that look similar to it. But I do want to say that there are two puzzles in the trade data that maybe don't quite fit with what you would expect from kind of the trade models and the consensus view on the way that Brexit should be impacting trade. And the first one is services exports. And I will come back to the data issues before anyone gets too kind of nervous on that. But services exports do look like they are are much more resilient than the rest of UK trade. So yes, there has been some sort of sectoral composition benefit. So the sectors that the UK specialises in are performing a bit better post-COVID and kind of through the COVID recovery than the ones that maybe it specialises less in. So if we think about certain types of travel where the UK does a little bit less of that exporting compared to the professional services sectors. But even when you account for this kind of tailwind, the UK still looks like it's outperforming a typical OECD country. So even when you account for its kind of sectoral makeup, that is, somewhat kind of unexpected when you think about, what you might have expected to see happening to UK services exports in the absence of access to the single market in its kind of nearest large services trading partner. The second one is this question about the EU intensity of UK trade. So how much of our trade is with the EU versus non-EU? As I said, you would have expected to see, because there were barriers put up with the EU, you'd expect to see the EU share falling. Again, this hasn't materialised, and as was kind of shown earlier for UK exports, and even for imports where it did happen a bit more strongly, it sort of has been improving. It has been returning to past trends in some of the more recent data. So one argument, a couple of the arguments kind of already brought up. So one argument is that this means that Brexit hasn't really had a big impact on trade. I guess my question on that is, if that was the case, then why is the UK underperforming, its G7 comparators overall? So UK exports do seem to be below where you'd expect them to be, even if they're not, the relative decline in EU versus non-EU trade doesn't necessarily match up to that. I think the other argument is, well, which was also brought up earlier, was that it's because of these complex supply chains. The UK imports something from France and then uses that as an input into what it exports to the US. And because of all the difficulties in getting it, it makes it harder to export to the US. If that was the case, then you can also look at just the UK's imports of final goods, so not goods that are being used in supply chain, so like the apples that you'd buy in the supermarkets. And if you look at that, there's no reason why those should be affected by these complex supply chain arguments. You should see the imports of apple. It should be now relatively easier to import apples from the US than it is to France, not in absolute terms, but in relative terms. And so you should expect to see it there, and again, you don't. So I don't think either of these arguments really perfectly answer that question, and probably both are kind of puzzles that sort of remain a bit outstanding and do need a bit more focus on. As I said, I was going to return to just one final point, which is the data issues, which are abundant. And I think the services kind of question is incredibly important. The UK is a massive services exporter, and it often gets very, very overlooked because people know the data is not very good quality. But we are a massive services economy, and kind of ignoring that and just focusing on goods exports is really missing a major part of what is happening in UK's trade performance. So it is really important that we look at it. But there are substantial and complex data issues, not just on the services side, also on the goods side. So on the services side, we have the ONS has been doing something called GDP balancing adjustments. I mean, these always take place, but in the last year, these amounted to almost £12 billion. an almost £12 billion adjustment to UK's services exports. And to give you kind of a bit of scale of how much that is, that really moves the UK from the very, very top of the pack, which I was looking at, the kind of G7 pack, where the UK looks like it's the best services export performer, to sort of very average and in the middle. And on the good side, we also have a huge number of data issues. So we have the fact that the measurement changes on EU trade from Intrastat survey measurement to customs. And the ONS has given some kind of indication of the scale of those impacts, so we can correct for those, and we usually do when we're looking at, how is the UK kind of performing, but it does inflate the UK's EU trade, relative EU kind of trade performance post-Brexit. And the second thing is that there was also some double counting due to delayed customs declarations, and there we have a much less accurate estimate of what the kind of scale of that impact might be, although it was just limited to a kind of 6-month period, so we can kind of work around it. But it might be that these data issues are a major component of the explanation for the two kind of trade puzzles that I set out earlier. But I think they are the kind of questions that we should be asking about. Are we seeing everything that we kind of expected to see overall? I think that's it.
Thank you, Sophie. Jonathan, Julian mentioned migration a little bit. It hasn't actually come up that much so far, but if we think about a lot of the reporting we do and a lot of the things we hear in the news, labour shortages and the ability of non-EU workers who are coming into the UK to not actually fill the jobs that were left by those EU workers who either left for Brexit or the pandemic has become quite an important political issue. So maybe you could spend a couple of minutes just talking about free movement and some of the migration elements of this Brexit debate.
I will do that. Let me start there with sort of a representative of the home team, UKICE, to try and sort of step back a bit and say, our job is to try and present a sort of objective view of social scientists, or to synthesize and bring together what, and in some sense I don't have a big dog in this fight, as Mehreen says. I'm an immigration economist far more than a trade economist. And what does this look like to me? First of all, I think hearing both Graham, Julian, and John's presentation, I have some considerable sympathy for their criticisms of some of the ways that the doppelganger, or what we call a synthetic counterfactual model, operates in this space. And it does seem to me that actually Julian's final point, is this quite past the smell test, is a valid one. I don't personally believe that the impact so far has been as high as 5%. On the other hand, I think the synthetic counterfactual method is, I think economists would agree, the standard approach in these circumstances. It is not to compare to some country that you choose to pick because it's large and nearby, and John is right about this. And the challenge, I think, for Graham and Julian to say, well, if you're going to come up with a quantitative estimate, what methodology would you use to come up with a quantitative estimate? Because if you're going to say, well, you should look at Germany or France, then no one is going to take that seriously compared to John's method, which at least is regarded by economists as being the least bad method to adopt. Now, you can do it differently, you can criticize it, but there is some responsibility on people sort of sniping at John, and I include myself here, as I say, because I don't quite believe the 5% either, to say what the alternative is. And I think, moving on to what Sophie said about trade, as Sophie said, the UK's overall trade performance has been lousy. And it's really a bit odd of Graham to show a chart showing that, well, trade is back. Having shown a bunch of charts comparing us with other countries, including France, Germany, and others, on trade, not to show on GDP, not to show the same chart on trade, which shows our underperformance is lousy. Our performance has been lousy. So I challenge here to Graham and Julian, do they accept that by any measure, including the ones that they've adopted, UK trade performance has clearly been pretty rubbish? And the most obvious explanation for that is Brexit. Because if you'd actually shown the same charts you've shown for GDP for trade, we know that's what it would have shown. So I think
where does all that leave me? Well, I'm going to ask everybody to say what their actual point estimate is for the impact of Brexit on GDP so far. We know, John's, it's 5.5%. As I say, I don't personally buy that. I personally would go for something in the region of 2.5%, but that's not scientific. I don't have a model, so that's my instinct based on my assessment of the evidence, all the evidence we've seen and others. But I would actually like each of the other panelists to actually give a simple number, 0, +2, or -5.5 in John's case, but whatever they actually think their central estimate is. Moving on then, I think my overall takeaway is that, and I sort of in the same, we haven't seen anything, it is in the same camp as the Bank of England and the OBR is. Yes, there's a lot of uncertainty. Yes, Sophie is right. The data, especially on trade, is a mess. But overall, there's all sorts. Julian mentioned the data, which both of us have looked at about why measuring the output of the public sector is different in different countries. That's a fair point. There's not a lot of reason. It's hard to justify moving away from the OBR and the bank central estimates. We seem to, what they say, well, what is the OBR and the bank saying? They're saying, well, we had a bunch of reputable economists doing reputable models pre-Brexit. They came up with this number. So far, it's sort of, there's no good reason for us not to assume we're broadly on track for that. And I just don't, nothing I've seen tonight has convinced me that there's any particular reason to change that very boring middle-of-the-road view about where we are. But on immigration, however, which isn't in the 4%, it's not in the BOE OBR 4%, there the facts have changed, and I've changed my mind on what's going to happen. I and others, including the Home Office, thought that the shift would have a significant, not huge, but significant negative long-run impact on GDP because we thought it would lead to a significant reduction in overall migration levels. And that would not be offset by increases from outside the EU, nor would it be offset from a shift towards more skilled migrants. So far, at least, though, the policy has been quite different from what we thought would be the case in 2017. It's been considerably more liberal, both towards skilled workers and towards workers in the health and care sector. I, like the OBR, have adjusted my views quite considerably. I don't see that negative impact anymore. And going more to sort of the longer term positive, I mean, John and I did some work, which some of you will have seen, saying that there is a shortfall so far. But I think already that is being at least part turned around. So while on the more, what are the sort of sunlit uplands here, there clearly are some significant economic and adjustment costs, which we are seeing now, as John and I set out, to the change to new migration system. But I think it's not unreasonable to suggest that most modelling, of the same sort of modelling that gave us the negative trade impacts from Brexit, would suggest that a somewhat more liberal overall and somewhat more skill-oriented migration system would, in 5 or 10 years, lead to UK GDP and productivity being higher than otherwise would have been. Now that, of course, assumes that politicians can actually withstand pressures to tighten the system again, because unlike trade policy where we sort of know where we are, migration policy is always subject to these political pressures. But if we stay on the course that we're on now, I'm relatively optimistic about the long-term impacts, and one might hope that over the long run that might offset some of the downsides on the trade side. Is that enough from me?
Thank you, Jonathan. I should also start with a correction, which is a terrible place to be. We started at 6:30. We didn't start at 6:30, we started at 7, so we're ending at 8:15, so it's an hour and 15 minutes. And for those of you who want to stay, we'll be around afterwards for drinks, so you can catch the panel there. Very quickly, Graham, I heard you whispering, but do you have that number for Jonathan? What's your number? Julian, do you have the same to you?
Can I say, it seems to me, it's slightly a criticism of my esteemed colleague of whom I've got the highest opinion, but to start introducing sniff tests and 2.5% is my view. This is getting ridiculous. People like John spent a long time trying to get a number, and we can debate whether it's a sensible number. I run a macroeconomic model. It takes me well, my wife complains badly of the amount of time it takes. We do this. It really isn't very helpful for people to start saying, you know, let's have a guess. But the work I have done in this Mehreen does suggest that Brexit has had negligible effect on UK's growth either way. If exports have been growing slower than in other, say, European countries, and there are, as Sophie said, big changes in the way things have been measured, so it's difficult. But if that's the case, why hasn't that fed through to GDP? I mean, in real GDP, we're growing about the same rate as Germany as we always have. I'm not sure about Sophie's point about it. Seems to suggest we were doing a lot worse than Germany. It's getting into Carney territory here, and Jonathan can perhaps come back on that. But I mean, we both Julian and I showed the charts for GDP in UK and Germany, real GDP, you know, and to the first approximation they're the same. And then there's a big problem then, I think, for people.
Sorry, that was coming back on my point. I was just making the distinction between real GDP and real GDP per capita.
Yeah.
So per capita, you didn't show, and the UK does underperform Germany. And I'm not saying that that's a Brexit thing. I'm saying there's a very long period of underperformance of the UK relative to Germany on a per capita basis.
Sorry, I missed that. Fair enough.
Since 2008.
Yeah. Sorry.
Before that, it was
since the
converging.
since the financial crisis. Yeah. So it's not just Brexit. It's since financial crisis, but
yeah.
whether there's a Brexit bit in
yeah.
there as well, it's just a different measure. It's real GDP per capita rather than GDP.
So we've got lots of questions. I'm going to group them together. One big theme is how to realise the benefits of Brexit, and what's the model and approach that the UK should take. So we got a couple of questions from Paul Giles and John Pete, who's also here, and they both sort of posit the notion that the only way to realise the economic advantages of Brexit to become a low tax, relatively deregulatory jurisdiction that can compete with the EU and sort of, you know, get rid of those shackles. Is that the only model? I think I would posit that we're seeing the UK's biggest neighbours sort of go headfirst into industrial policy, which seems to be the counter opposite of that version of a low tax deregulatory environment. They want to spend lots of taxpayers' money pumping into, you know, state aid and green industries. So Graham, Julian, do you have any thoughts about what should be the economic philosophy that can best realise these benefits?
I'll just go first.
Please.
Well, I'll go first. But first of all, I'll just quickly answer Jonathan's question. From sort of economic first principles, economic 101, if you like, I think the initial economic impact of Brexit has to be negative, because what you've done is you've increased trade barriers, you've reduced the freedom of movement of labour, and you've increased business uncertainty in particular. So whatever my number is, it would initially be a negative. My feeling is it would be nearer 1% than 3%, but I think you have to acknowledge the initial impact of Brexit has been negative. However, I think that was always likely to be the case, because you're shaking things up, you're doing the bad things first, you're not yet doing the good things that hopefully will yield long-term benefits. And also the period of change is the one of maximum uncertainty before businesses have time to adjust. So I think the negative impact initially has been smaller than people say, and also is likely to be more transitory than many people assume. Brings me though to the benefits. I'll dismiss one straight away, which is the saving of whatever it is, 20 billion or whatever, on payments to the EU. Because if John and others are right, that's more than offset by the hit to the public finances from a weaker economy. So I dismiss that. Instead, you have to go down two other routes. One is the better regulation of the economy. Not necessarily deregulation, it's not necessarily a bonfire of regulations, it's just doing things better than the EU would have done. I could come up with a whole host of examples there, and things like agricultural policy, biotech, financial services, and so on. Big caveat there, though, straight away, is that what we've just agreed with the agreement on the Northern Ireland Protocol, which I think does threaten to tie the UK very closely to single market rules for the foreseeable future. So that avenue is rather narrower than it was. And then the second route, of course, is the opportunity to lower trade barriers to the rest of the world, not necessarily with the EU, but the rest of the world, either through new free trade deals or unilaterally. And again, unfortunately, there's a big caveat there, is how willing is this government or any other government to seize those opportunities. We've seen the pushback against, for example, the Australian free trade deal. The problem with free trade, as you know, is that overall it's a net positive for the economy. But the costs are concentrated amongst a relatively small group of people who find it very easy to form lobby groups and push back. So all we see is the National Farmers Union saying this is a disaster, rather than people speaking up for consumers for whom free trade is a benefit. So I am nervous. I think Brexit has created these opportunities, but it's a fair question whether this government or any future one is actually going to take advantage of them.
Graham?
I agree very much with Julian's last point there. I mean, whether we get any benefit from Brexit or not depends what UK governments do. So far, they've seemed to have taken very little advantage of it at all. And it may be difficult to take much advantage, partly because all these regulations that people complain about from Europe, I mean, the great majority of those are global regulations coming in. That, nobody wants their sofa to catch fire. Nobody wants their toddlers to lick lead paint off toys. Et cetera, et cetera. So there's probably not all that much scope, in my view, for gaining through regulation. So I don't know whether we'll get much benefit from this. We certainly have to strike out in a very different direction if we are to get much benefit. But can I say, I didn't vote for Brexit because I thought it was going to be economically wonderful. I agreed with Lord David Frost. I voted for Brexit in order to take part in meaningful elections. Meaningful elections can lead you to better policies or not. But given the shambles we've had over the last few years, we're a long way from that.
John, can I also ask you about this point about the economic model? So there are some small areas where the UK has tried to diverge. Financial services is one of them. We're now in a more volatile financial services environment, and maybe trying to cleave out a more competitive city is not going to be in line with what we're actually seeing happening in the markets. But is there an opportunity for this sort of regulatory arbitrage that the UK can make the most out of in green regulations around net zero? I mean, is there sort of some low-hanging fruit that maybe this government or the next one can look at as sensible and politically feasible?
Yeah, I mean, obviously there are, regulation is just a fact of life. Regulation can be poorly designed. There are things that the EU got wrong, right? So there are going to be some benefits to, in some cases, if we get it right, to regulating some sectors better. But there are a few reasons to think. I agree with Graham that I don't think this is going to have much impact on overall performance. One is that the UK was a relatively lightly regulated economy as part of the EU. If you look at all of the measurements of how regulated the economy was, put together by the OECD, it was much less regulated than the United States in some areas, particularly in product markets. And it had a relatively lightly regulated labour market as well. So the gains that you can get from pushing that back still further aren't going to be very big. There's definitely some advantages in agriculture because I agree with your criticisms of the Common Agricultural Policy, Julian. And I would add genetically modified organisms. These are things which can potentially improve the productivity of agriculture. But it's a small, very small share of the UK economy, 1 to 2% max. And there are lots of things that we can do with biotech and data and all of that kind of stuff. But generally, there have been various studies which have been done to try and assess, what's the impact of deregulation on growth. And the answer is not very much. Final point on finance, there's obviously a trade-off here, as we saw with Silicon Valley Bank, which was tinkered with. The financial regulations which were intended to try and keep these banks safer were tinkered with by the Trump administration. And Silicon Valley Bank ended up being more lightly supervised and regulated than it was before the Trump administration. So yes, you can say, okay, we're going to try and reduce oversight here, we try and reduce regulation, but you create risks in other parts of the sector. And so, generally, whenever you talk to financial regulators, they say we're not here to be light touch. We're here to try and seek competitive advantages where possible. But the first and most important thing is stability. And I think that is going to serve your growth prospects much better than a competitive race to the bottom.
I thought it was also quite ironic to note that the Chancellor decided to impose a fiscal straitjacket on himself, which almost exactly mirrored the EU's fiscal rules of keeping the deficit below 3% and having debt declining. So maybe on that sense, we're not going to see
just
too much
say,
of a
I think the
divergence.
tax question is a red herring because there's nothing really to stop us from cutting most taxes in the
Inside
UK.
the EU. Yeah, and Ireland is a...
Possible with the exception VAT would be the obvious one.
Yeah. I'm going to allow those of you who came to see us to have some privilege. So if anyone wants to put their hand up, we do have a mic at the back. So we have one gentleman at the front and the lady in the blue just behind. So, did I miss anyone else's hand? Because we can group them together. Actually, we'll start and then we'll take two there.
Okay. Yeah.
Keep them short and snappy.
Yeah. Putting my own cards on the table, I voted Remain, but I think what will improve the UK economy is if we brought forward at a fast scale infrastructure projects like Heathrow expansion, HS2, and also bring forward at a fast pace North Sea oil gas expansion and the coal, which is a vital feedstock for our steel sector.
And the two ladies just behind. And let us know who you are as well. Thank you.
Hi, my name is Carol Kilgore. I write for The Conservative Woman. My question is relating to the budget. What are your thoughts on the 25% corporation tax rate now as applied to the situation of independent contractors, people who work in tech, for instance, who will now have to pay higher taxes? What effect do you think that will have on the UK economy?
Yeah, and just the lady next. Yeah.
Hi, my name is Andrea Bisi, fellow dual American-British. Wanted to ask John, were you attributing the collapse of Silicon Valley Bank to the policies from the Trump era? No, okay.
That was quick.
No, well, if everyone's aware, if you're going to point fingers of people in administrations during financial collapses, Barack Obama's chief of staff, Rahm Emanuel, was a director at Freddie Mac during the collapse, and I have to say that was, I think Freddie Mac and Fannie Mae were long-standing.
Sure. I mean, I don't think John was making a point about the equivalence between SVB. And actually, given that that was less of a question, we've just got a gentleman just behind Anand. Yeah. And we'll take those three.
Neil Ward, University of East Anglia. We've got a huge challenge with net zero for the economy over the next 27 years, and I just wondered whether the panel thought that Brexit frees us up and gives us any greater prospect of being able to do a just net zero transition for the economy.
So we have a question about needing more investment, particularly in transport networks. What everyone thought about the planned increase to the headline rate of corporation tax, and then also about net zero. Who wants to have at it?
Have a quick go?
Yep.
I think the general point to make is that, in a sense, none of those are really questions about Brexit, and they're very, very important questions in their own right. I can happily speak for ages about the UK's corporate tax regime, for example, and I think the increase in the corporation tax was a big mistake, even though it was partially offset by the investment allowances. But that's not a Brexit issue. We could have done that, or we could have done pretty much anything independently of Brexit. On the opening question there about infrastructure investment more generally, again, I was struggling to think of a Brexit angle on this, but then I reflected on two, actually.
I mean, if pressures of Brexit led to more investments in infrastructure, that's what I mean.
Yeah, but of course we could have done that anyway. But the two ways I thought it was a Brexit angle, one is a lot of that might be around the issue of state aid, and it might be, many people on the left, if you like, the Lexit group, who support Brexit because they think it's an opportunity for more state intervention in the economy, which is interesting because I supported it because I thought it was an opportunity for less state intervention in the economy, which shows that people voted for Brexit for very different reasons. So that might be one part of it, is that you can do more state subsidies if you wanted to, though I personally wouldn't. The second point is around Solvency II, so the financial sector, making it easier, for example, for insurance funds to invest in longer-term infrastructure projects, which is something that the UK is very keen to do. There was a caveat there. I suspect the EU might well move in that direction in due course as well. So it might be that we get a head start on them, but we might have ended up in the same position if we'd remained a member of the European Union.
Just on net zero, we've also got some questions about industrial policy and green industrial policy and whether the UK should basically be following the Inflation Reduction Act playbook, which we know that Europeans are very upset. The UK is also not particularly happy, but it hasn't really said what it was to do. Graham, Jonathan, Sophie, what do you think about this sort of burgeoning debate about active industrial policy and
I
state
can
aid?
cover sort of why the idea that the UK can just kind of fight fire with fire maybe is not really going to work. So the nature of the industrial policy with the big subsidizations and the policy which relies on limiting companies' ability to use imports in their supply chains is effectively like a large component of how the Inflation Reduction Act policy will work. And the UK can't really just replicate that in the same way. And the reason is the size of the domestic market. So if you're the EU or if you're the US, you have a massive domestic market, or in the case of the EU, effectively a massive domestic market of the 27 countries that are members of the EU. And so that gives enough weight and enough ability for the firms that are benefiting from that kind of additional protectionism to get up to the scale that they need to, and then they can kind of export outside of there. And that's not really a possibility for the UK. Because we are a much, much smaller market, and you need to have access to those EU and US markets, which you're not going to have because of the policies that they have in place or that they might put in place. That's not to say that you can't have like a sensible industrial policy around net zero and around green issues, and you should. You just shouldn't try and like compete on a kind of like for like basis, and the policies just shouldn't be just replicate, which potentially was the question. There's two things to also remember with those policies. Like one is like we shouldn't forget that for consumers, and actually these are global goods. These are kind of global goods with a positive externality, like actually having more subsidies and having more investment in some of these industries is a good thing for the world, like not for UK producers who will potentially suffer from them. And it is the UK producers that are the real losers here. And as I said, the second thing is that you just need to be a lot more targeted and a lot more intentional in your kind of industrial policy. So which are the areas in those kind of supply chains where those protections aren't already applying to producers in the US or in the EU, and where the UK has a comparative advantage or has some natural strengths in which it can, not need to rely just on its domestic market, but still kind of export the goods that it's producing. But yeah, just as a kind of high-level answer.
Yeah, just building on that, Julian's right, of course, and Graham implicitly was right. That the point of Brexit is we can choose. We can have massive industrial policy, or we can have total unilateral free trade. But I think what's come out of this discussion is that the IRA and other similar moves shifts both the politics and the economics of that in a not necessarily favourable position for the UK. With a good, strong global trading regime under minimum standards, controls on excessive subsidies, the rest of it, WTO fully functioning, we might have gone down. It might have been more plausible to go down the sort of route that Julian's gone down. Equally, but unfortunately, that's much harder if that system isn't working, and it's not. So that puts a premium on us having an industrial policy, but actually the trade-offs of us having an industrial policy, as Sophie just said, are considerably more negative when we're on our own. And that means that for an industrial policy to work, we're going to have to be really good at it. And history, and maybe we can, that's the Starmer-Reeves prospectus for what it's worth. That somehow we'll suddenly be really good at doing industrial policy outside of either the EU and the UK. Call me cynical, but... and just finally on the corporation tax, I'm not going to do a long thing about corporation tax, where Julian knows far more, but just on the small contractors point, the 25% only applies above 250, so it's not as bad as you think.
smaller businesses pay a slightly lower rate of 19.
Not up to 19, up
90.
to 50, and then slightly going up. But anyone under 100,000 isn't going to have a big
Will be
hit.
exempted, exactly. We're running out of time, but I'm going to leave it to our last three speakers. I'm going to give you 30 seconds each to give some closing remarks. And also, if we're back here in a couple of years' time, given the fact that we will enter into general election year next year, probably towards the end of next year, are any of the things that we've spoken about today, the longer, medium run-ish trends that we've seen, do you expect anything to really change in terms of Britain's economic landscape? So I'll give you 30 seconds each, Graham, Julian and John, and then we will wrap up.
The really big potential advantage of Brexit is reorienting our trade to faster growing parts of the world, particularly in the Far East. We're about to announce membership of the Trans-Pacific Partnership, which is rather oddly named, but it includes quite a lot of the old Commonwealth. So we're getting back to them, and they're quite fast growing. Just one quick point on corporation tax, which I've looked at a lot through studying the Irish economy. It does tend to work. Managing directors don't get off planes and say, you know, I'm here for the tax advantages. They always say, I'm here because of your wonderful workers, and etc. But actually, when you look at the record, they do follow the tax advantages quite a bit. That doesn't necessarily mean that it pays for itself. So there are problems with somewhere like the UK. Clearly, it does pay for itself in Ireland, but the really odd thing about Ireland is it doesn't seem to have increased their living standards. It doesn't actually get down to the population. There's a lot of money swilling through Ireland.
I think the alternative measure that the Irish Statistics Office showed, the economy is actually in recession. So we have to sort of discount a lot of the slightly more...
in living standards, they're actually a poorer country than us. But if you look at GDP per head, that says they're nearly double UK standards. And if you believe that, you believe anything.
Julian?
Well, just very briefly, if I focus on the sort of three negatives that I described from Brexit so far, I think there are good reasons for all of them, not necessarily turn into positives, but at least to diminish over time. One is the disruption to the freedom of movement, but as Jonathan says, we might end up with a regime that's just as good or potentially even better. The second is the various new trade barriers with the European Union, particularly the non-tariff barriers, the red tape and so on. But over time, we'll get better at dealing with that. And then the third is the impact of uncertainty. And I think it's perfectly plausible to believe that business investment is lower than it would otherwise have been because of that additional uncertainty. But I think that will fade over time as well as people adjust to the new regime and we fix some of the problems in the existing system. And throughout this period, actually, the UK has remained at or near the top of lots of polls for attractiveness as a place to invest. Similarly, the City of London seems to have largely escaped unscathed from Brexit. So as this uncertainty clears, I think there is actually quite a lot of scope for more investment back into the UK. And I think the scope for a massive increase is limited because, as we've argued before, we don't think there was a big fall because of Brexit to begin with.
In 30 seconds, what Brexit has done has made the economy more rigid and less able to cope with shocks. So if you think about COVID, for example, we ended up with a very steep recession and a big climb out of it. We had a surplus of demand over supply, which is why we've ended up in inflation. One of the things that you can do to help with that is to import more labour. Not being in the free movement zone has made that more difficult. You can also
500,000 last year, Jonathan.
No, I know, but most of those weren't for work, right? And so the work that Jonathan and I don't know if you've seen it, but we end up with quite a sizable shortfall up to 2022. That, as Jonathan says, that might dissipate in time. In terms of the manufacturing sector, then we've imposed some sizable trade barriers on our manufacturing exports. That is going to be quite difficult to surmount. It's not going to get any easier. The costs of getting over the border frictions are going to remain the same. So we can just say that manufacturing output that we would have sent to the EU but is now uncompetitive because of those trade barriers, that's gone, right? So, and then finally, there are some reasons for a bit of pessimism, I think. One is that the EU is moving towards industrial policy in ways which is inimical to our interests. For example, the carbon border adjustment mechanism means that some of our heavy industry is at least going to have to go through a lot more paperwork in order to be able to export their products to the European Union. And we're in the middle of a subsidy race between the US and the EU, which is going to inflate the size of their manufacturing sectors. It's harder for us to do the same thing, largely because there's a real fear in the Treasury that those subsidies are going to be wasted because our manufacturing sector is less competitive. So I'm not saying that this is that this is total doom and gloom. We will start growing again. My point is just that we have to be honest that Brexit does mean that the economy is going to be smaller in the long run than it would have been. My estimates are what they are. I stand by them. But I don't think that we can think, oh, well, the benefits of Brexit are going to come along down the line if we just try hard enough. These are big geopolitical issues, but they're also just about the technicalities of trade and the difficulties of getting over border frictions. So that's it.
Thank you. On that note, John.
Yeah.
For those who want to stick around, I think we'll be just outside. So my last task is to thank all the panelists. Thank you guys for coming, and hopefully we'll see you soon.